Are you thinking of getting a second mortgage in Canada? First off, what is a second mortgage? Owner-occupied property, what does that mean? Simply put, a second mortgage is when you take out a second loan on an already mortgaged property. Generally, a second mortgage will be in the form of a home equity line of credit, HELOC, or another mortgage, a home equity loan. Borrowing amounts are usually lower than your first mortgage, and interest rates are often higher. People often take out a second mortgage to consolidate their debts, pay for major purchases like home improvements, or for investment purposes like a down payment on a second property. What is the difference between HELOC and home equity loan? If you already have a mortgage, good credit, and more than 20% equity in your home, you may be able to get a second mortgage in the form of a HELOC. This is a revolving line of credit that lets you borrow money when you need it, up to a specified limit. You're most likely to find major banks offering HELOCs to people who can get approved, and interest rates will be anywhere upwards from around 2.5 to 3%. With a HELOC, you can access and repay the money whenever, similar to a credit card. A home equity loan, on the other hand, is a lump sum payment which you will pay back in monthly installments, just like your first mortgage. A home equity loan is more accessible for people with lower credit scores and/or less equity in their property. Generally, home trusts and private lenders offer these types of loans at higher interest rates than a HELOC, from around 10 to 15%. With that being said, how much can you borrow with a second mortgage? According to the Canadian government, you can borrow up to 80% of the value of your home after subtracting the balance on your first mortgage. In other words, with a second mortgage, you can borrow up to 80% of the equity in your home. The average credit limit for a HELOC in Canada is about $150,000. Other private lenders may allow you to borrow more than 80% of the equity of your home, but at a higher interest rate than a HELOC. The next question is, how do you qualify for a second mortgage? To qualify for a second mortgage, lenders will assess the following areas. Equity. Equity is the amount of the total value of your home that you have already paid for. The greater your equity, the better your chances for qualifying for a second mortgage. Income lenders will look at your income to make sure you can keep up with the repayments on your second mortgage, whether it's a loan or a HELOC. Credit score. A credit score of 650 or higher will help you qualify for a HELOC. Good credit shows your lender that you're responsible with your money and can make payments on time. The better your credit, the lower your interest rates will be, and the more likely that you'll be approved for a second mortgage. You might be wondering, is a second mortgage worth it? Many Canadians choose to take out a second mortgage on their home. If you already have a good amount of equity in your property, above 20%, and you're looking to free up some extra cash, a HELOC or a second home equity loan could be the right option for you. Besides being a great way to consolidate debt and help you meet your other financial obligations, one of the main benefits of a second mortgage is that you can borrow money without changing the terms of your first mortgage, as you would in refinancing, for example. If you manage to secure a low interest rate in your first mortgage, taking out a second mortgage wouldn't affect this. Not sure what to do? Chat with a Nesto advisor today and kickstart the conversation to see if getting a second mortgage is right for you.